If you observe carefully what's happening in the financial markets right now, you'll notice something peculiar. While everyone is celebrating new highs and recovery narratives, the smartest institutions in the world are quietly exiting specific asset classes at an unprecedented rate. In the past 18 months, central banks have reduced their holdings in certain assets by over $180 billion. This isn't random. This isn't market timing. This is the largest coordinated exit from specific investments we've seen since 2007. And if you're holding these 5 assets in your retirement portfolio, you're standing on the wrong side of history. The question isn't whether these assets will underperform. The question is whether you'll recognize the warning signs before it's too late. This isn't a prediction. It's a logical consequence of policies already in motion. I've spent over 40 years studying how debt cycles, currency debasement, and political incentives create predictable outcomes. When you understand incentives, you understand behavior. And right now, the incentives are perfectly aligned to destroy the value of 5 specific asset classes that millions of Americans are holding in their 401ks and IRAs. Consider these facts. The United States federal debt now exceeds $36 trillion, representing 124% of GDP. Real interest rates, when adjusted for actual inflation, remain negative despite rate hikes. And most critically, unfunded liabilities for Social Security and Medicare exceed $175 trillion. These aren't opinions. These are mathematical realities that create a specific playbook for how governments must behave. To understand which assets are designed to fail, you need to understand 3 fundamental principles. The first principle is the difference between nominal protection and real protection. Nominal protection means your account balance stays the same or grows in dollar terms. Real protection means your purchasing power is maintained or enhanced. When governments face unsustainable debt, they always choose to protect nominal values while destroying real values. It's the path of least political resistance. Think of it like a restaurant that keeps prices the same but cuts portion sizes in half. You paid the same amount, but you got much less food. That's exactly what happens to certain assets during currency debasement. The second principle is counterparty risk concentration. Some assets require you to trust that another party will honor their obligations decades into the future. Other assets have no counterparty. They simply exist and have value because of scarcity or utility. When system-level stress increases, assets with counterparty risk become increasingly dangerous. The third principle is liquidity illusion. Many assets appear liquid in normal times but become impossible to exit at fair prices during stress. This is particularly true for assets that depend on continuous buyer demand rather than fundamental scarcity. History is an excellent teacher, and we've seen this pattern repeat multiple times with devastating precision. In 1971, when President Nixon closed the gold window and ended dollar convertibility to gold, anyone holding long-term government bonds denominated in what they believed were gold-backed dollars lost 41% of their purchasing power over the next decade. The bonds paid their stated 6% interest like clockwork. Account statements looked fine. But inflation ran at 8 to 12% annually, destroying real returns. A $100,000 bond portfolio in 1971 was worth $160,000 by 1981 in nominal terms. But in real purchasing power, it bought what $95,000 bought in 1971. You made 60% nominally, but lost 5% in reality. In the 1970s, workers who kept their pensions in traditional fixed annuities watched their purchasing power evaporate. Teachers, municipal workers, and corporate employees who retired in 1970 with what seemed like generous $1,200 monthly pensions discovered that by 1980, that same $1,200 bought what $450 bought when they retired. The pension fund paid every penny promised, but those pennies became nearly worthless. Meanwhile, those who had invested in farmland, energy companies, and gold saw their assets rise in value specifically because they protected against currency debasement. During the 2008 financial crisis, people holding mortgage-backed securities discovered that AAA ratings from prestigious agencies meant absolutely nothing when the underlying collateral lost value. Bonds rated as safe as U.S. Treasuries fell 60 to 80% in value within months. Retirement accounts holding safe corporate bonds saw losses of 30 to 40%, while the rating agencies slowly downgraded what markets had already recognized as toxic. The Latin American debt crisis of the 1980s showed what happens when governments promise returns they cannot sustain. Investors who bought Mexican, Argentine, and Brazilian bonds yielding 12 to 15% discovered that restructuring meant receiving 30 cents on the dollar years later. In Japan's lost decades, bonds yielded near zero, while deflation made cash king. The opposite problem, but same lesson. Understanding the economic regime matters more than following conventional allocation rules. In Weimar Germany in the 1920s, citizens who held government bonds and bank deposits in marks saw their life savings become literally worthless within months. A bond that paid 100,000 marks in 1921 would buy a house. That same 100,000 marks in 1923 couldn't buy a loaf of bread. Meanwhile, those who held real assets, property, commodities, foreign currency, survived and thrived. The pattern is always the same. Governments facing unsustainable obligations have only three choices: default explicitly and admit they cannot pay, default through inflation by paying in devalued currency, or default through financial repression by forcing citizens to hold negative real return assets. They always choose the last two because they're politically palatable. No elected official has to announce, "We're defaulting." Instead, they simply let inflation run higher than bond yields and force pension funds to buy government debt regardless of return. And when they make that choice, 5 specific asset types always get destroyed first and most completely. Let me tell you a story about 2 families I observed during the 2008 to 2020 period. The Johnson family, ages 58 and 60 in 2008, had $650,000 in their retirement accounts after decades of diligent saving. They followed conventional advice from a reputable financial advisor. 60% in long-term government and corporate bonds yielding 4 to 5%, 30% in dividend-paying blue-chip stocks, and 10% in cash equivalents and money market funds. They felt safe. Their advisors showed them charts proving bonds were the conservative choice for people nearing retirement. The allocation was textbook perfect according to modern portfolio theory. The Martinez family, same ages in 2008, same initial savings of $650,000, same middle-class background, took a fundamentally different approach after studying monetary history. They kept only 25% in short-term bonds with maturities under 3 years, allocated 25% to inflation-protected treasury securities and TIPS, 30% to carefully selected commodities including energy partnerships and agricultural positions, 15% to international diversification, including emerging market bonds and currencies, and 5% to physical precious metals as systemic insurance. Their advisor told them this was too risky, too unconventional. Fast forward to 2020. The Johnson family had $890,000 on paper, a 37% nominal gain that looked impressive in quarterly statements. They felt successful. But when adjusted for real inflation in the categories that matter to retirees, healthcare costs that rose 65%, food and energy costs that rose 45%, and housing costs that rose 38%, their purchasing power had actually declined by approximately 8%. They had more dollars but less real wealth. More critically, their income from bonds had been cut in half as rates fell from 5% to 2%, and they were forced to reinvest maturing bonds at lower yields. Their expected $32,000 annual income from the bond portfolio had shrunk to $17,000, forcing them to draw down principal faster than planned and extending their work years. The Martinez family had $1,140,000, a 75% nominal gain and a 45% real gain when adjusted for the same inflation measures. Their purchasing power had actually increased significantly. More importantly, their income stream had grown rather than shrunk because their inflation-protected allocations automatically adjusted upward and their commodity positions generated rising cash flows as resource prices increased. They retired comfortably at 65 as planned, while the Johnsons worked until 68. By 2024, the gap had widened further. The Johnsons, now 74 and 76, had $1.05 million, but faced $180,000 in unexpected medical expenses, and watched their fixed bond income get destroyed by the 2021-2023 inflation surge. The Martinez family, same ages, had $1.68 million, with income streams that had adjusted upward automatically. They were helping their grandchildren with college costs, while the Johnsons were considering downsizing their home to free up capital. This isn't made up, it's the typical pattern we see when people understand which assets provide nominal protection versus real protection. The difference isn't intelligence or luck, it's understanding the monetary regime you're operating in and positioning accordingly. Both families worked hard, both saved diligently. But one family understood that the game had changed and adapted their strategy to the new reality. Now let's translate this to what really matters, how this affects you. If you're 55 years old with $500,000 in your retirement accounts and 40% of that is in long-term bonds, you're holding $200,000 in an asset class designed to lose purchasing power. Here's the mathematics. If real inflation runs at 6% annually while your bonds yield 4%, you're losing 2% in purchasing power each year. Over 10 years, that's an 18% real loss on that $200,000, or approximately $36,000 in purchasing power destroyed. But the real danger comes when interest rates eventually rise to combat inflation. A 3% increase in rates causes a 25 to 30% price decline in long-duration bonds. Suddenly, your $200,000 allocation is worth $140,000, and you're looking at a 30% nominal loss on top of the purchasing power erosion. Think about what that means in daily terms. If you planned on $40,000 annual retirement income from that $500,000 portfolio, and 40% of it loses 30% of its value, your safe withdrawal drops to $32,000 annually. That's $8,000 less per year to cover healthcare, housing, food, and the lifestyle you worked 40 years to achieve. Based on these principles, here are practical guidelines for what to avoid and what to prioritize. The 5 assets designed to fail in 2026 and beyond are long-term government bonds with maturities beyond 10 years, traditional fixed annuities with no inflation adjustment, cash hoarded in money market funds earning negative real returns, overpriced growth stocks in sectors dependent on free money policies, and commercial real estate in secondary markets facing structural decline from remote work and demographic shifts. Let's address each specifically with the mathematics that reveal why they're structurally doomed. Long-term government bonds are a mathematical trap that becomes more obvious once you understand the government's incentive structure. When the government owes $36 trillion in acknowledged debt and has $175 trillion in unfunded obligations for Social Security, Medicare, and government pensions, the only politically feasible way out is currency debasement. They cannot raise taxes enough. Confiscating 100% of billionaire wealth would run the government for 6 months. They cannot cut spending enough. Entitlements are politically untouchable, and interest on debt is non-negotiable. The only path is to repay debt in devalued dollars. Your 30-year Treasury bond yielding 4.5% will mature and pay you exactly what it promises in nominal terms. But if real inflation averages 6% over that period, you lose 1.5% annually in purchasing power. That compounds to a 36% real loss over 30 years. If you hold $100,000 in long bonds, you'll receive $100,000 back in 2054 that buys what $64,000 buys today. Meanwhile, the government celebrates that it honored its obligations perfectly. The safe allocation to bonds should never exceed 15% of your portfolio, and it should focus exclusively on short-term bonds with maturities under 3 years that can be rolled over at higher rates if inflation persists or moves into inflation-protected tips that adjust principal with inflation. Traditional fixed annuities are equally dangerous because they're designed to transfer inflation risk entirely onto you. Insurance companies promise you a fixed payment for life, but they make no promises about what that payment will buy. Run the numbers. If you're 65 and purchase an annuity paying $3,000 monthly guaranteed for life, and inflation runs at just 5% annually, in 15 years when you're 80, that $3,000 buys what $1,440 buys today. You've lost more than half your purchasing power while the insurance company celebrates that they paid every penny promised. By age 85, that $3,000 payment is worth $1,100 in today's dollars. The insurance company's liability decreases in real terms every year while your cost of living increases. Only consider annuities with explicit inflation adjustments, and even then understand that the insurance company builds in assumptions that favor them over decades. Cash in money market funds feels safe psychologically. You see the same number every day, no volatility, no scary market swings. But it's financially dangerous because it guarantees purchasing power loss. With real inflation at 5 to 7% annually, the true costs of food, energy, healthcare, and housing, not the manipulated CPI, and money markets yielding 4 to 5%, you're guaranteed to lose 2 to 3% purchasing power every single year. If you're holding $100,000 in cash as a long-term position, you're volunteering to lose $2,000 to $3,000 in real wealth every year. Over a 10-year retirement, that's $25,000 in purchasing power destroyed through the illusion of safety. Cash should represent no more than 6 months of expenses as emergency reserves, not a long-term investment strategy. Overpriced growth stocks in speculative sectors that thrived on zero interest rates face multiple compression that will be brutal. When money was free from 2010 to 2021, investors paid 60 to 80 times earnings for companies promising growth in electric vehicles, cryptocurrency, space exploration, and artificial intelligence. The logic was that future earnings would justify current prices. But as rates normalize and liquidity tightens, those multiples compress to 15 to 25 times earnings, destroying 60 to 70% of stock value, regardless of whether the underlying business performs well. A stock trading at 70x earnings at $100 per share trades at 20x earnings at $28 per share, even if earnings stay flat. The business didn't fail. The valuation regime changed. If you're holding speculative growth stocks purchased during the easy money era, you're holding time bombs waiting for valuation reality. Commercial real estate in dying markets combines the worst elements: long-term fixed leases that don't adjust for inflation, declining demand from remote work destroying office utilization, and illiquidity when you need to exit. Properties in secondary cities seeing population decline, think Detroit, Cleveland, Baltimore, are experiencing 30 to 40% value drops that will take decades to recover if they ever do. You're locked into an illiquid asset in a declining market with tenants demanding lease concessions, while property taxes and maintenance costs rise. The promised 7% cap rate becomes a 3% return after vacancies and concessions, then becomes negative when you need to sell and discover there are no buyers at any reasonable price. What should you do instead? Allocate your portfolio to assets with these characteristics. Short duration so you can adapt. Inflation protection built in. No counterparty risk or minimal counterparty risk with strong collateral. Global diversification to reduce political risk. And real scarcity rather than artificial scarcity. A prudent allocation for someone aged 50 to 70 with retirement savings might look like this: 25% in inflation-protected securities and short-term bonds. 30% in carefully selected dividend-growing companies with pricing power, 20% in commodities and real assets including energy, agriculture, and materials, 15% in international assets including emerging market bonds and currencies, 5% in physical precious metals as systemic insurance, and 5% in cash for opportunities and emergencies. The key is gradual implementation over 6 to 12 months. Don't panic and sell everything tomorrow. Instead, as bonds mature or reach target prices, reallocate systematically. When you receive dividends, direct them to underweighted categories. If you have new contributions, direct them to the protective allocation rather than the legacy allocation. Psychologically, prepare yourself for volatility. Real assets and commodities experience sharper price swings than bonds. You'll see 15 to 20% drawdowns followed by 30 to 40% recoveries. That volatility is the price you pay for inflation protection. Traditional bonds gave you smooth statements but guaranteed purchasing power loss. Protective assets give you volatile statements but real wealth preservation. Common pitfalls to avoid. Don't try to time the transition perfectly. Don't abandon the strategy during the first market dip. Don't over-concentrate in any single asset. Don't forget to rebalance annually. And don't let recent performance dictate future allocation. The assets that perform best in the 2010-2021 period of easy money will likely perform worst in the 2024-2030 period of currency stress. Nothing in this constitutes specific financial advice. Each person has different circumstances, time horizons, risk tolerances, and goals. What works for a 55-year-old with $500,000 may not work for a 72-year-old with $2 million or a 45-year-old with $200,000. Consult qualified professionals who understand both traditional portfolio theory and monetary history before making significant changes. But here's what you need to understand philosophically. The financial system is at an inflection point. Debt levels are unsustainable. Political incentives favor inflation over austerity. And the traditional 60-40 portfolio of stocks and bonds was designed for a world that no longer exists. That world assumed moderate inflation, positive real interest rates, and governments that honored the real value of their obligations. We no longer live in that world. The choice is yours. But remember what's happening behind the scenes. Central banks have reduced government bond holdings by over $180 billion in 18 months. Sovereign wealth funds have increased gold positions by 1,100 tons in the past 3 years. Pension funds are quietly shifting from long-duration bonds to infrastructure and real assets. These institutions understand incentives. They're not speculating. They're protecting purchasing power. That's why this channel exists, not to make predictions, but to observe what's already happening and translate it into practical guidance for people who spent decades building their savings. We observe signals before they become obvious. We study history to understand the future. We recognize that protecting wealth is not the same as growing wealth, and sometimes protection is the wiser strategy. If this analysis makes sense to you, if you believe that understanding incentives helps you understand outcomes, subscribe to this channel. We'll continue examining the forces reshaping global finance and translating them into actionable intelligence for people who have too much at stake to follow conventional wisdom blindly. The assets you hold today will determine the life you live tomorrow. Choose based on principles, not popularity. Choose based on history, not headlines. And choose based on what protects real purchasing power, not nominal account balances. The system doesn't care about your retirement, but you should.